Do you align with the market expectation that we are going to see around about 130 odd basis points or so of cuts coming through for the course of this year?
Well, remember the way the markets are priced. I mean, there's always going to be a hedging factor where the markets are priced for some kind of a disaster or recession. So if the Fed ends up cutting, let's say, 4 times, the markets will always be priced for 5 or 6. I think that, I think 3 or 4 rate cuts is likely. So I tend to lean against the idea that the Fed's going to go 6 or 7 times this year, but I also understand why the markets are priced the way they do. There's always an expectation of recession that bond traders kind of bid up. And I don't think that that's likely. So, 6 is one of these weird numbers where it's too many if the economy is expanding, which it is, but it's not enough if there's a recession. So, my sense is that what we're going to get this year is largely a recalibration of policy. We know that the U.S. economy is on pretty firm ground. So I think it's going to be very difficult for the Fed to deliver any more than 3 or 4 this year.
And you knew exactly where I was going with that. So it's not your expectation that we are going to see a recession of any form in 2024, because I can understand in terms of, what we've seen on the fiscal side and all of the juice that provides for the GDP and the expectation in an election year, that's not going to necessarily dry up. But there's no worries at any of the data that we are seeing under the hood in terms of the health of the consumer and I suppose that the health of businesses moving forward?
Well, I mean, there's always concerns. The question is whether the concerns are any greater than they typically are. And I would say the answer to that question is probably no. I mean, you talk about the consumer. Real incomes are rising at a, relatively firm pace. I mean, you're talking about 2.5% to 3% growth in real incomes, excluding transfer payments. I mean, that's a pretty robust pace of income growth. And, the important thing is that the labor markets are solid. I think we'll see more evidence of that later in the week. But the important thing is, to the extent the labor markets have slowed, inflation is slowing much more rapidly. And when that happens, you're basically generating a tailwind for real incomes. And what are people doing with that growth in real income? They're going out and spending it. We just learned in the fourth quarter that consumer spending ran about, close to 3% at an annual rate. I mean, you're talking about the U.S. economy here. If you get the consumer right, everything else will more or less fall into place. So if the consumer is growing at about 2.5 to 3, I just can't get that worried about the economy. And I think that the bigger story is that inventories in the U.S. have been unsustainably drawn down, right? So if you have consumer spending growing at the rate it is and inventories not really pushing GDP up, retailers are going to have to replenish inventories at some point. And when that happens, you're going to see a pickup in manufacturing production in the U.S. So I think, indicators like the ISM later this week will also be important.